week after the Fed, and what we want to do today is we want to not just shine a light on what the Fed just announced. In fact, they didn't announce anything which we didn't knew already before, but what is of higher interest certainly for us is in this context, what impact does this have on the markets? What could this mean, especially for precious metals, for the US dollar? And this is exactly what we want to look at here in the upcoming minutes then. And in this context, what I want to show you right now, I want to show you here my screen and the agenda for today. So there we go. So first of all, we want to dig deeper into the question, why are precious metals worth a deeper look, especially in the current market environment? What's the main reason for that? In this context, we want to also look back at one topic we already had in the past on quantitative easing, what this is, what this means, what this aims on to achieve. And in this context, so just let me wait a second. We will certainly, there we go. We will certainly here in this context and mainly and foremost look at the developments we have seen here in regards to the Fed, in regards to the ECB, especially the Fed. But in the morning, this morning, I came across a tweet which mentioned that the ratio of balance sheet to the GDP in the Eurozone is currently at over 70% and will continue to rise, which is also shining, let's say, a quite difficult light on the monetary policy from the ECB. Probably the ECB will rather sooner than later run out of ammunition in this context and have some trouble to stabilize the euro, which is probably especially interesting then for euro holders. I'm not sure. So people out of the Eurozone, not necessarily out of the US. Here, why gold also in euro terms is probably of high interest. And in this context, we need to also shine a light on the developments in the yield world, in the yield universe right now. In the yield universe, what do I mean by that? Well, the thing is that we have an environment in which currently yields pick up, while inflation stays quite stable, which means that we currently see, after the sharper rise higher in real yields, or it was more like a drop. Sharper rise means in sharper rise into more and deeper negative territory. So it was more like a drop. So that once here, the tide turns. Inflation expectation among market participants reach a new high. Currently, they start to gain momentum, but it's not that we currently see really inflation really picking up. Here in Germany, for example, let's put it out of this perspective. So that's why I'm a little, probably especially a little scared. We just prolongated this lockdown craziness. I don't know what to say what to say about that anymore. And the thing is that right now, today it was decided that there's no complete lockdown around Easter, and it wasn't just that our government planned to shut down everything, or in terms of people keeping them at home and extend the Easter weekend from 3 to 5 days. But we are really talking about they wanted to shut down everything and not lock down, but shut down everything. So which is, especially from an industrial production perspective, not doable. And finally, politicians realized that, and then so they step back from that. But just imagine the following. So industrial production is about, or they at least start to discuss that, shutting down everything while they keep on pumping, as we will see here, money into the financial system. And the combination, well, what does this mean? Well, that means nothing more that rather sooner or later you will see inflation picking up. And because there is less goods out there and more money, which will naturally increase prices for these goods, which means inflation will pick up. And this means that real yields especially will potentially drop then And if real yields will drop, well, what we get to see in this context naturally is that such asset classes, especially precious metals, but also mining stocks in this context. And mining stocks, not just related to gold, but also to silver, probably especially junior mining stocks are of high interest, of high interest in terms of potential, not value, but yield and return, which could be extraordinarily high, especially in this regard here. And that being said, we will look at the end of this webinar at a list of potential investments in gold, silver at Admiral Markets, or currently rebranding to Admirals, true multi-asset broker, with the possibility for us to not just invest in CFDs and speculate on short-term swings on the long and short side, but in addition to that, also invest longer term via, for example, ETFs, but also physical stocks then. And this is exactly what we want to look at, and which ticker symbols you should look up in this context to get further information. So that's me. My name is Jens. I'm located in Berlin, in Germany. I'm 36. I'm sorry. How old am I? Yeah, 36. I'm sorry. I'm 36 years old. And I'm in the financial industry for over 15 years at least. Started at a stockbroker here in Berlin, Germany, and learned trading from scratch. Probably have heard the story before. So I did an interview together with Admirals already 2 years ago, around 1.5, 2 years ago, when we started this Spotlight series, especially now the Hot Topic webinar series. And in this context, just check out the webinar, the interview for further details on my person. That's probably not of so much interest right now, nothing really new. What's certainly new is the rebranding process currently taking place at Admiral Markets. Well, you will now find also admirals.com. And Admirals, the rebranding process takes place because now the financial service provision here is extended, and it's not just limited to multi-broker, multi-asset brokerage, but also in addition to that, there are other financial services like a credit card, for example, which could be of interest. So definitely check out admirals.com for further details. In Germany, that's something I'd like to mention at the end here, is that here in Germany we refer usually to Admirals as the DAX expert, with a probably most competitive offering when it comes to DAX CFD trading, FX trading, highly competitive in terms of the spread, highly competitive in terms of the commission. So definitely something to consider when you plan to, or probably about, or currently looking for a new broker. Then give Admirals definitely a check out here and check the website for further details. So now what we want to do is we want to here start or dive into this topic and answer the question why investments in precious metals are worth a deeper look. And in this context, want to give the quantitative easing, in short QE, a deeper look here. So quantitative easing is a form of unconventional monetary policy. And with QE, a central bank purchases longer-term securities from the open market in order to increase the money supply and encourage lending and investing. Okay, so that means buying these securities adds new money to the economy by expanding the central bank's balance sheet. And when short-term interest rates are either at or drop below zero, the normal open market operation targeting interest rates are no longer effective. And then a central bank can target specified amounts of assets to purchase. So this is the theory behind this. Great, nice to see that. What we want to do here is we want to give this a direct view here and have a look at the balance sheet and the developments there. So we have in blue the central bank balance sheet from the FED. And we have in black here the central bank balance sheet from the European Union, from the Eurozone, respectively the ECB in this case. And so what we do here is, in fact, that we can see, what we do here, respectively what we can see, this is probably of more and higher interest, we can see that both lines are nearly going vertical. Similar, and especially here in terms of the blue line, the FED balance sheet, going vertical on the upside. And now this after, obviously, COVID-19, the pandemic hit here. And now the question might arise, why this happened? Well, obviously, the target is to cap yields or to make money cheap as possible and pump liquidity into the markets to keep the, put this in quotation marks, system afloat. I think we can easily put this. And so in this context, what we now certainly wonder is, what does this mean for the money we have? Respectively, what can we expect to happen? Will this turn rather sooner than later? So this is probably the first question we should answer here. Is it likely that this current verticalness, we can call this, will change? And the answer to this is no. And it's clear that this won't happen. And therefore, what I did is I prepared, let me just check. I think I have it here. No, I'm sorry, here. There we go. I prepared it already. So what we have here is, this is the last economic projection, but also here, this is the announcement from last week on Wednesday in this context. So what we have here is the statement that the Fed will continue to increase bond purchases by at least 80 billion per month. So 80 billion per month, that equals to nearly 1 trillion per year right now of treasuries, and 40 billion per month of MBS. MBS is mortgage-backed securities, until, and this is the crucial word, until substantial further progress made on max employment and price stability goals. So what they say, in fact, is we plan to increase our balance sheet more and even more and more and more, and we decide when we will end this. I mean, at the end, certainly they decide when they will end this, but there is no clear number they are looking at here. Like, okay, they say, okay, we look at the employment rate or employment situation, but what they say is we want to see substantial further progress being made on maximum employment. So that's what they are targeting. Why do I emphasize this? Is quite simple. I'm in this industry for quite a while now, and I'm looking at the markets. I'm trading the markets for quite a while, and the last time I've seen that they attached their balance sheet expansion post the great financial crisis in 2008, when they started here and when they initially went vertical the first time and started to massively increase their balance sheet and buy assets to keep yields at a very low level. That was here in 2009, and in 2013 there was then first signs that probably there will be a time when this support of the economy by buying bonds and pumping liquidity into the system will come to an end. And what they did is they said somewhere in 2013, yeah, we will start to discuss. And it wasn't that they said we will stop then buying bonds, but we will start to discuss in this context to taper once we reach an employment rate here of 6.5%. And why this is of importance is 6.5%, that was a number which, and this is something we, I'm sorry, I haven't prepared this, but a number you can see was reached that was already somewhere at the end of 2013, 2014, I'm not really sure. They reached it and they never really continued, or they started to taper, yes, but it wasn't that they started to decrease their balance sheet substantially here in this context. But what they in fact did was they waited and kept interest rates low. And then they started to finally increase yields. That was, I think the first step was taken at the end of 2014, if I'm not mistaken. So it was a really, really long time. And after they finally hiked rates the first time for several years, and then continued to hike rates, and then started to reduce the balance sheet. That was starting in 2017, end of 2017, and then 2018. And they were talking about this process running on autopilot Well, what we've seen is the massive volatility hitting the markets at the end of 2018, massive volatility. And then they had to start to buy bonds anew, starting from 2000 and one second, please. Starting from 2019, September around anew, because Ripple markets went crazy back then, and liquidity was massively drying out in the credit markets, and there was a potential liquidity crunch happening there. And so why this is of interest and why this is noteworthy is in this context, because it shows that it will take a long time until we see a kind of a normalization there, if we get to see a normalization at all, because we are within this cycle and this process already for quite a while now. And even if they probably start to do that one day, it needs to be seen whether this will be sustainable, or they have to go back into the QE mode again quite aggressively quite soon again. And by the way, in this context, we also need to say, okay, if they do not reduce or if let's say they increase their balance sheet, probably they will stop one day, but then the next step is hiking rates, and then they probably will start to reduce their balance sheet. So when can we expect yields to be hiked, or interest rate hikes? In this context, it's necessary to have a look here at the so-called FED dot plot. And the FED dot plot gives you a very simple idea on where is the Fed, respectively its members, where do they stand currently? What do I mean by that? Well, what we have here is that for each dot plot, for each dot, you have one Fed member and his view on the economy, respectively, not just the view on the economy, but also where he sees rates for example, the year of 2020. So these are the projections from December 2020. We don't have them yet, if I'm not mistaken. I think the next minutes will be released somewhere in 1 week or something like that. So we are 1 week early, but this doesn't really matter because this hasn't substantially changed here. And what you can see, and this is to make a long thing short, what you can see is that till the end of 23 here, there is no Fed member, or the majority of Fed members continues to see yields from the Fed at 0 to 0.250. So at 0. Which means nothing more than for the upcoming 3 years, we shouldn't expect any action to happen here from the Fed at all. And this is very important because it gives us already an idea on what to expect in terms of the monetary policy and where things are headed, especially with all the uncertainty around the COVID-19 pandemic and the especially economic impact this will have, not just in the US, but also probably especially in Europe with all this. Yeah, we have to say that. I mean, this is 100% mismanagement, what we see here from the German government especially. And this is noteworthy for the whole European Union. Why? Well, because Germany is the biggest economy of the Eurozone. And if the European economy is stuck, it took Germany in the past to get things going again and keep somehow acting as kind of a train which moves forward and takes everything with it, economy-wise. And now the train is broken. Let's put it that way. So meaning that a broken train in this context means some bad outlook for the overall economic situation in the Eurozone in general. So that being said, means nothing more than we can definitely be sure that this QE madness and this massive liquidity pump won't change soon. And this being said, brings us now back to the presentation here. And our expectation, especially in terms of inflation picking up, why this is of importance. Again, the simple idea behind this is that we say, well, if there's no economic growth, but liquidity, which is massively pumped into the system, there will be rather sooner than later some kind of pickup in terms of economic growth that will massively result with probably a kind of a hyperinflation resulting out of this, because now all the liquidity starts to flow directly straight and without hesitation into the market. Or you don't see any pickup in economic growth at all, and no real no real goods being produced, or at least not that it corresponds with the money flowing into the system, resulting in expectations around inflation picking up quite soon based on more liquidity being available, prices picking up, even though there's no kind of economic growth. So probably you have kind of a stagflationary environment, and inflation picks up too. So there's, well, you can look at this from both sides, with the stagflationary developments probably being a little more likely, let's say. So that being said, what does it mean? Well, that means, in my personal opinion, it means nothing more that rather sooner than later, real yields. So this is the difference between what, for example, a government bond pays you, US government 10-year T-notes or something like that, and inflation, and you subtract inflation from the T-bond or a T-note yield in this context. And if this is negative, then usually an investment in a precious metal like gold, for example, is more attractive. Gold has this saying that it's not attractive from a cash flow perspective because it's a gold bar. It's just a bar, and it's not paying you anything. It's probably conserving your growth, or not your growth, your wealth, but it's not that it works in some way. It's just it's there. It's a bar. That's it. Zero yield, no cash flow, so not very attractive. And the only thing you can do is profit from it from a wealth preservation perspective. So once yields start to turn negative, and the more negative they get, the more attractive it is to hold gold, because with zero yield, it's still way more attractive than having an investment which is paying you, let's say, -1%. That makes perfect sense. So that being said, it becomes clear why this real yield picture here, so the blue line, and if you then overlay this with gold, why these two charts are positively correlated to each other. Usually they are negatively correlated to each other. That's something I need to add here, because the treasury inflation indexed yield is inverted in this case. So what you do here is usually you see a divergence. So the deeper into negative territory real yields drop, the higher gold should rise, and the other way around. In this case, we just inverted the inflation, not the inflation, the 10-year real yields here to show you a little better how this correlation plays out here. And as you have seen probably in case of gold, there has been a drop already over the course of the last 6 to 8 months, 6 months. Yeah, 7 months. It's probably 7 months. So I think we peaked out somewhere in August, if I'm not mistaken. And so yeah, what we've seen here in this context is that real yields started to drop too, but not as aggressively from its, or not drop, but it started to rise again. So we have to here look at inverted yields. So if inverted yields drop, that means that real yields picked up and are not as negative as they used to be in August anymore. And what we get to see here is right now that gold is massively underperforming, in my personal opinion, despite the fact that we already know that from a global macro perspective, from a fundamental perspective, as we've seen based on the statement from the Fed, based on this central bank balance sheet developments, that right here, there is no real reason to believe that there will be kind of a, how can I say that, kind of a change, at least not in the near future, in the near term, which means it's difficult to understand why, especially some or an asset class as gold or precious metals in general, but also mining stocks, are currently underperforming. most likely it is probably because we've currently we currently see kind of an, let's call it, expectation that there will be back to normal, let's say, and that markets will rather sooner than later find themselves on the growth path again, and there will be economic growth. Probably that's main reason for that. But I have to say, I'm very skeptical, and I think there are plenty of other guys out there who are also very skeptical, looking at the current mismanagement when it comes to the pandemic and vaccination and all this. I mean, again, I'm located in Berlin and I'm in Germany, and in Germany things are really not really good. We are not really good. It's not really good looking what you're going to be seeing. And probably, at least that was what I've heard, there's some people around the world laughing about the Germans and their mismanagement and the mismanagement of the government. We really have no idea what's going on there right now, so we don't see that. And this is probably one of the reasons why I'm even more skeptical when it comes to the overall expectation in terms of economic growth in the near term. But all in all, I just doubt, even if I'm very skeptical due to the fact and the developments we see here in Germany, I have to say that even if you look at this from a pure common sense perspective, let's call this, I'm somehow convinced that people will naturally ask the question, how shall a normal look like with trade taking place as we used to see it in the past again, with people distrusting, mistrusting the government around the globe. I think this is not just a German issue, but it's also a European issue, respectively. It's also something we've seen in the US taking place already when you just look at the last US presidential election. And Trump, I mean, at the end, it was a close call, and it was minimum 50% who voted Trump again, despite everything what he probably did wrong, even though I'm not the right one to judge here whether his policy is wrong, right, or wrong, or how to judge it. But let's put things into perspective here. Seeing a country being this divided is a clear sign that it will be very difficult to get back to the, let's call it, growth path, or back to a normal as we used to know it, let's say 2 years ago. And that being said, leaves me very, very skeptical in terms of the overall economic outlook, which means nothing more than there's much liquidity being provided from central banks, but no economic growth on the other hand, resulting in potential stagflationary tendencies, meaning real yields will drop into very negative territory, which is usually very bullish for gold. And given the current underperformance in gold, probably also one of the reasons why we should be really positive also in the short term in terms of potential outperformance in markets like gold. And so that being said, by the way, this is here a Twitter feed I highly recommend following. It's Jerome Blokland. So for further information, just check out his Twitter account for such charts here. And now what we want to do is, I mean, the overall idea is, or the question we have here is it just gold? Is it just silver, or other ways to probably profit from the current environment? And what I want to show and want to share with you here is the correlation between gold and mining stocks. And what I use here is the so-called supreme add-on from Admiral Markets and the so-called correlation matrix. So in this context, let me just go over to the website here from Admirals and then show you where you can find this. So you have, 1 second, please. So take some time. Products, and then platforms. I'm sorry, platforms, and here is the MetaTrader Supreme Edition. And if you have if you have a demo account, you can download this for free and add it to your chart. Everything described here in this section. And by the way, I just have to open here on a second screen. I have to open the webinar on YouTube and just check out whether there are any questions. No, so far not. But if you have any questions, please feel free to ask them also here on YouTube. So I just want to make sure that I'm not missing any questions. Perfect. So that looks good. Scrolling down a little, you will see, let me just see if it's brought up here. So there's the mini terminal. Here's the trade terminal. There's the tick chart trader, connect indicator package. Okay, so it's not explicitly mentioned here, but the correlation matrix again can be found within the Supreme add-on package. So just that you know where you get this. And what you can do then is you can compare different markets with each other. And in this context here, you can see that if you compare gold with ABX, this is the ticker symbol for Barrick Gold. Newmont is let's call it direct competitor from Barrick Gold here, NEM. And then we have GDX. This is the Van Eck gold mining stock ETF here in this context, where, by the way, NEM and ABX have an overall weight of more than 20%, at least I think. Not sure whether it's 25%, has been 25, I think, last year, after this massive run higher in both stocks in ABX and NEM. But all in all, you can see, and this is a daily chart, and this is for the last 500 days, if I'm not mistaken. So you can see here that there's a high positive correlation. So if one trades higher, usually the other should trade higher too. The reason for that is quite easy to understand. I mean, if the gold price goes higher, usually you expect the gross margin here of these companies, potential gain they make based on their selling their gold, physical gold. Usually you expect the gains to increase too, and thus the earnings per shares and this the stock price. So that being said, you can see that there's several ways, not just to speculate, but also to invest in this development if you share this point of view. And so what I want to show you now is I want to answer for you the question why gold mining stocks are of high interest in the current environment, especially gold mining stocks. And therefore, here I have a chart from Crescott Capital, LLC. This is, as far as I know, an asset manager. Not sure if it's a real hedge fund, but it's at least an asset manager. And what they do here is they have a look at the free cash flow yield in case of gold miners. And just to give you a quick introduction of what we talk about when we talk about free cash flow yield, this is a financial solvency ratio that compares the free cash flow per share a company expected to earn against its market value per share. So the ratio is calculated by taking the free cash flow per share divided by the current share price. Okay, that sounds a little academic. In short, it means nothing more than the higher the free cash flow yield, the more likely a company is generating enough cash to easily satisfy its debt and other obligations, including dividend payouts. So, and this is very, very good information, and you can see why this is of high interest. Well, if you just have a look here, going back till 1995, 25 years, these gold mining stocks used to be classic capital destroyers. So you invested there, but you didn't really make any true money based on developments. The developments here, especially after the great financial crisis with the run higher up to nearly 2,000 USD per ounce in gold, for example, back then to new all-time highs. That was when this flipped here, and now after gold bounced again, and we traded as low as, if I'm not mistaken, 1,100 USD per ounce. So there was nearly a 50% corrective move from these highs of 2011, 2012. We switched back into positive territory again. And as you can see, we stabilize in positive territory, which means if you translate this, we are not talking about a capital destroyer anymore once investing in a gold mining stock, but it's more like you start to talk about a potential, at least, wealth stabilizer. Probably a wealth increaser. Yeah, I'm not sure whether this is the right word, but that's why gold mining stocks are of interest. And I personally would say this is definitely worth a deeper look because, and this is the thing, companies like mining stocks like ABX/Barrick Gold or Newmont, they also start to pay a dividend, which is of interest because if you invest in a highly positively correlated to gold asset like a gold mining stock, which is strongly positively correlated to the gold price, and you say, well, I don't like gold because there's no cash flow included, but it's only gains which result out of capital gains, the market moving in my direction. What's then of interest is a gold mining stock due to the fact that they pay out a dividend, even though it's just a small one. But the idea behind this is very similar to the idea of investing in a growth company. If you're buying, let's say, Amazon stock or something like that, the thing is they don't pay a dividend too. So they reinvest in their business model. So far went out pretty well. If you look at the stock price, if you look at the market share, which Amazon has. But what I'm talking about here is if you're looking for an investment in this area due to all the fundamental developments, from a macroeconomics perspective, probably especially, what you should definitely take into account is a mining stock which pays dividend, even though it's just a small one, but still it's a small dividend you get. And what I have here now is a potential list of potential investments which you could take into account when looking at investments into this. If you come to the same conclusion, if you say, well, this is something which is also making me think about the whole situation in general, what's currently happening with the central banks. I mean, they really went crazy, put this in quotation marks, but they really went crazy in terms of expanding their balance sheet already post the great financial crisis. Still, that wasn't just a big deal because the thing is that this mainly pushed asset prices higher. It inflated certainly real estate prices. It inflated certainly equity prices. It certainly inflated bond prices, for example. But in the end of the day, you still had, let's call it, some kind of economic growth, and there was no such thing as protectionistic measurements from governments. Probably you could argue, well, that changed a little with Trump. That has been the case in China already before, but all this compares or is nothing compared to what we currently see in developments around COVID and the destruction of the overall confidence in our economic system as a whole. If you also, beside here, the idea or the thoughts around precious metals, around mining stocks, if you look at developments in Bitcoin, for example, all this is mainly resulting, and this vertical move is not just a speculative move higher, but there's also many traders or market participants, long-term investors probably, involved who say, I think the end, in this case, of the US dollar, in our case, in the Eurozone, the end of the euro probably even earlier than of the US dollar is probably near, or at least there will be a massive switch towards a decentralized currency, in this case, a cryptocurrency based on a blockchain technology, which is avoiding such a monetary policy excess, liquidity excess, which you currently face. So if you come to this conclusion, and you have probably wondered if there's other ways besides physical gold or physical silver, there are other ways, and you can all access them with the MT4, MT5 solutions from Admiral Markets in this case. So the invest solution especially gives you access, and this is the reason why you see hashtags here, and sometimes there's no such thing as a hashtag. So if there's no hashtag, that means this is the physical stock you can buy only from the long side, then via the MT5 invest solution from Admiral. While here you need a trading account and you can trade the stock also. If you completely disagree and say, well, it's nice that you say that, but I don't think so. I think there will be a return to normal economic growth, rising yields, dropping or increasing real yields, which is a bad environment for gold at all. I favor the long side. This is then probably the moment to say, well, I want to short such mining stocks, which is possible if you trade a CFD. So shorting CFDs, or here in this case, a CFD on a stock like ABX is also possible. NEM in this context, also here, a mining stock, which is of interest. Those two were already mentioned. What's also interesting here is the PAAS, respectively AG. This is interesting. Let me just go over here to Admiral Markets, and then let's check out here the products, and there the shares. You have the chance to click here on show all shares, and then if we click on type in, that's probably a better way to put it. Here, enter the symbol. If we do AG, you see that AG there is First Majestic Silver Corporation, quite big player in this industry. And then we have also PAAS, which is Pan American Silver Corporation. So these are two share or companies which focus here on silver mining in this context. And why is silver of interest? Well, silver, there's some very interesting attachment to silver, which is not given when trading gold. Silver has also, or is in use when it comes to or when you're looking at industrial metals. And so even if probably my whole picture does not play out as painted for the overall economy, if we have economic growth, you could yourself probably find in a spot where Pan American here or Silver Majestic, those two companies, or in general, also an ETF like SLV in this context, find a favorable market environment because of economic growth results in stronger industrial demand, which usually pushes silver prices higher too. And that being said, is also important because of all the developments then in the electric vehicles sector, for example, where silver plays an important role when it comes to the building of batteries, if I'm not mistaken. So all in all, we find ourselves in a favorable environment from both sides, macroeconomic wise, but also economic wise. If I'm completely wrong and the economic growth picks up and inflationary pressures pick up, then silver could be in a really win-win situation, and then see a massive rise higher, from which also here stocks in silver mining companies then would massively profit. And so that being said, and this is the potential list of investments in gold, silver at Admiral Markets. So check out the website for further information on them, and let us know what you think. So in this context, if you watch this on YouTube, please leave a thumb up here. Please subscribe to the YouTube channel. If you have a comment please below the video. If you have questions around this list, for example, where to find it, also please feel free to ask the question right below the video. If you have, in addition to that, if you're willing, if you're interested in discussing thoughts around investments here or trading ideas, also check out our Trading Spotlight webinar community in this context, which was set up for the Trading Spotlight webinar series and now is extended to our hot topics like the one today. And so that's this in this context, where you can also find further information and discuss this then in further detail. And now this brings us already to the summary of today's webinar. So, this is not so good. Let me just okay. I sum this up, and then the next slide I have to see whether I can sum this up quite quickly in terms of the next webinar taking place. This will be, if I'm not mistaken, it will be Paul's. And let me just check here. Do I have Paul's next topic? One sec. So usually we have a folder here which gives us information around this, and unfortunately, I'm currently having trouble to find this. That's not so good. Let me just see if I see that, if I found it. So Paul will be here. That's for sure. If I don't find it, by the way, it's no big deal, because then we just head over to the website admirals.com for further details. So, however, QE and the expansion of the QE of the FED and the ECB balance sheet with the target to drive yields to lower levels below zero makes investments in precious metals like gold and silver very attractive. gold and silver investments from several perspectives. So not the only a way to invest is via the gold CFD or silver CFD in this context, but also certainly gold mining stocks like ABX, like NEM, so ABX Barrick Gold, NEM Newmont, ETFs like GDX, so for example, the FANEC gold mining stock ETF. They are highly positively correlated, as I've shown you, to gold in this context and the price of gold. If you expect gold to push higher, then usually ABX and Newmont and also the ETF GDX should follow suit. And in this context, it's also interesting from a long-term perspective, from a pure fundamental perspective, that these mining stocks have seen a recent switch into positive territory here, in terms of free cash flow yield, which makes it very, very attractive then from an investment perspective, an alternative in addition to a portfolio to hedge against the devaluing US dollar. Respectively, if you say, especially, I want to see, or I want to have a cash flow component within my portfolio, then certainly such mining stocks also make definitely sense to give them a deeper look here in this context. And so now I will just head over to the website from Admirals, and then let me just check here. Okay, perfect. So let me just check out here the Educations tab, Forex and CFD webinars, and I will share this link with you here to the webinar. So if you're already registered, by the way, for trading Spotlight webinar series, here Trading the News is the upcoming session, then you will just have to check out your inbox for the link in this context. So webinar with Paul, I call this. If not, then feel free to check out admirals.com, head over, Education, Forex tab, and then Trading the News. That will be the event on next Friday, 26th of March. In this context, you're definitely invited. Feel free to check out Paul's great content on this context. In this context here, you will find out how to trade, or why people trade the news, how to trade, or how to best get the information together to trade news in the future, and also what you need to be aware of. That's especially true, for example, for the spread, which widens certainly around or due to liquidity issues during news, because market participants get out of the market before the news, delete orders, which naturally increases volatility, respectively, sees the spread widening. And once the spread tightens again, this is usually a sign that now the news is priced in, and that now trading under, let's call it, normal circumstances is possible again. So this will be a topic then next Friday in the webinar, Trading the News with Paul. And this is not right. This is the wrong slide. This is the right slide. For further information, check out the website from Admirals. For further information, check out also the description box of this video if you're watching this on YouTube. If you need further information on Admirals in general, shoot an email, subscribe to the YouTube channel, turn on the notification bell here. And since Admirals is a highly regulated broker, fully regulated broker, there's the risk disclaimer at the end. So happy trading from my end. All the best. See you next week on Friday then, with the next Trading Spotlight webinar within the series together with me. That's it from mine. So all the best. Happy